Hey folks, Berk here. This week on Wall Street was the kind that slaps you across the face and reminds you who's really in charge. Markets opened the week strong, riding a wave of cooler inflation data and soft landing optimism. But by Friday, boom, that rally got vaporized. The S&P 500, Nasdaq, Dow, all of them reversed. Why? One word, war. We'll break it all down in today's wrap. What happened, why it matters, and what you should actually do about it. And before we dive in, take a second, tap like, hit subscribe, and double-click that bell. That tiny click helps keep this evidence-based content alive. Let's get to it. We started the week with some of the best economic news we've seen in months. Inflation cooled, consumer sentiment bounced. The Fed looked like it might actually cut rates later this year. Markets loved it. The S&P was less than 2% from all-time highs by Thursday. Then Friday hit, and reality struck hard. Israel launched direct strikes on Iranian military and nuclear targets. That escalation sent oil surging and stocks spiraling. The Dow dropped more than 700 points. The Nasdaq fell 1.3%. The S&P sank 1.1% and ended the week in the red. This is what a geopolitical shock looks like. One headline wipes out a week of gains. One missile reroutes capital around the globe. Here's something else the headlines buried. The consumer was finally feeling better. The University of Michigan's Consumer Sentiment Index jumped 16% in early June. First gain in 6 months. That's not a small thing. It reflects relief. Relief from inflation, relief from policy volatility. People were starting to believe the worst was behind us. But, and this is key, most of that survey happened before the war news broke. So, sentiment looked backward. The market is always looking forward. And right now, forward means oil shocks, supply chain disruptions, and uncertainty. Now here's the kicker. The same thing that had been helping cool inflation, lower energy prices, just reversed. West Texas crude jumped 7.5% on the week. Brent wasn't far behind. That's a big deal. The CPI and PPI numbers told us inflation was softening. Headline CPI was up just 0.1% for May. Core CPI also up just 0.1%. That's the slowest pace in years. Gas prices fell. Service inflation eased. The market was pricing in a rate cut. But now, higher oil prices are threatening to undo that progress. Inflation might rear its head again. And the Fed is cornered. Ease too soon, you stoke oil-driven inflation. Hold tight, you risk slowing growth. The FOMC meeting this Wednesday just got a lot more complicated. Let's talk about the real battlefield, the companies. Winner of the week? Oracle, up 24%. Yes, 24%. Their cloud business is exploding. AI infrastructure demand is off the charts. They locked in $138 billion in future revenue. That's not hype. That's booked business. On the flip side, Boeing. A tragic 787 Dreamliner crash in India, 241 lives lost. The first fatal crash for the Dreamliner line in 16 years. The stock fell 5% in a day. Boeing's credibility, already hanging by a thread, is once again under the microscope. Visa and MasterCard, they got smoked. Amazon and Walmart are exploring launching their own stablecoins, digital payment rails that would cut out Visa and MasterCard altogether. That's billions in fees at risk. Visa fell nearly 5%. MasterCard dropped 5%. This isn't science fiction. It's a real threat. Even Adobe got hit. They beat earnings, but their AI narrative didn't impress. The stock dropped 5%. Good isn't good enough if your growth story doesn't scream AI at the top of its lungs. So where does that leave you? This week wasn't about the Fed. It wasn't about earnings. It was about geopolitics hijacking the narrative. If wealth is your goal, here's the truth. You can't plan around every shock, but you can own the right kind of businesses. Oracle surged because it's solving real problems with durable demand. Visa dropped because its business model is under threat. Energy stocks like Halliburton jumped 14% because oil matters again. You want to build wealth? Own businesses with pricing power, strong balance sheets, and mission-critical products. The rest is noise. Here's something else the headlines buried. The consumer was finally feeling better. The University of Michigan's Consumer Sentiment Index jumped 16% in early June, first gain in 6 months. That's not a small thing. It reflects relief. Relief from inflation. Relief from policy volatility. People were starting to believe the worst was behind us. But, and this is key, most of that survey happened before the war news broke. So, sentiment looked backward. The market is always looking forward. And right now, forward means oil shocks, supply chain disruptions, and uncertainty. Markets will stay volatile, but volatility isn't your enemy. It's your reminder. A reminder to stay aligned with a plan, a reminder to own real assets, and a reminder that news doesn't create risk, it reveals it. If you're not sure what you own or why, let's talk. Subscribe, like, and double tap that bell so you don't miss the next one. And if you found this helpful, share it with a friend who's still chasing headlines instead of building wealth. See you next week.